Hello and welcome to this reading in Portfolio Management, Portfolio Risk and Return. So the starting of this reading, okay, these are the LOS requirements. Okay, you'll see that there are a couple of things that you've already done. Okay, the risk and return measures and all that, the holding period return and this that, already in the portion on quantitative methods, and therefore I'll not be spending too much time here. Okay, on the same concepts that we've done. Okay, I've just given the formulas, couple of illustrations, and then we can move ahead. The same concepts, I won't be even repeating them. Okay, you need to be smart enough in order to understand that there should not be any duplication of effort. For example, holding period return, it's the closing price minus the beginning price plus any cash flows that have been received during that particular time period, let's say dividends or interest coupons, divided by the original price. That's the, what do I say, that's the holding period return. Simple. So that has to be absorbed very quickly and flipped through very fast by you, and not put in extra effort and time over here. For the purpose of completeness of the video and the slides, I have put in those formulas and everything, but you need to be smart enough in order to gauge that these points have already been covered, these aspects have already been covered, and therefore there's no point in re-emphasizing them again here. Okay, it just should be a revisionary mode going on for you for the concept that we've already done. So financial assets are generally defined by the risk and the return characteristics. This makes it easier to value them and simplifies the process of determining which assets must be included in the portfolio. Financial assets may provide one or both of the following types of the returns: periodic income such as dividend and interest income, and capital gains or losses arising from the change in the market price. The first metric is the holding period return, which is simply the return earned on the investment over a particular time period and is expressed by the following formula. You can see here that this part, okay, is the capital gains and this part is the dividend yield. So the return is a composition of the capital gains and the dividend yields. The holding period return may also be calculated using the following formula. Do note that we've assumed that dividend is paid at the end of the period. If the dividend is paid at any point in time before T, we would also have to account for the return earned by investing the dividend for the remainder of the period. This would lead to higher holding period return, obviously. Arithmetic return, geometric return, money weighted return or the internal rate of return, okay, annualized return, okay, the monthly return and annualized return, okay, the portfolio return, what is the portfolio return on a particular portfolio, okay, the return on the portfolio is simply the weighted average of the returns on the individual assets, just doing a weighted average. Okay, so these all metrics had already been discussed. Okay, so now we'll be moving towards variance and covariance of returns. Okay, the risk of an asset or a portfolio of assets can be measured by its standard deviation, which is the positive square root of its variance. So therefore, variance can be calculated as the following formula. Variance is the average squared deviation of the observed values from their mean. A higher variance indicates the higher volatility or dispersion of the returns, and the population variance can be calculated by the formula on your screens, where RT is the return for the time periods, T is the total number of periods, and mu is the mean of the returns. Obviously, if only a representative sample of the population was available, then in the sample variance calculation, you would have done P minus 1 and we would have taken R bar over here. Okay, that's a mu only, but R bar is the average of the sample. Okay, and in the denominator, we would have taken as T minus 1. We all know that the standard deviation is the root over variance, and with the help of the formula that we've just seen on the slide, standard deviations can be calculated as follows. Okay, this is the population standard deviation, this will be the sample standard deviation. If we move the root over sign, then that is the population variance, and standard deviation can also be calculated as the following formula. Earlier in this reading, we learned that the expected return on a portfolio of security equals to the weighted average of the individual securities. In fact, when I was explaining portfolio return only, I said that. However, calculations of portfolio variance and standard deviations is not straightforward. In addition to being a function of individual asset variances and their weights in the portfolio, portfolio variance also depends on the covariance between the assets in the portfolio, and therefore the variance of two asset portfolio can be calculated using this following formula, and similarly the standard deviation can be calculated using this formula. The first part of the formula for the two asset portfolio standard deviation, that is weight square plus variance, weight square into variance plus weight square into variance, tells us the portfolio standard deviation is a positive function of the standard deviation and the weights of the individual assets held in the portfolio. The second part, twice into weight into covariance between the two assets, shows us that the portfolio standard deviation is also dependent on how the two assets move in relation to each other, either covariance or correlation. Historical mean return and expected return. Again, this is a concept that we already discussed. Historical return refers to the return that was actually earned in the past, while expected return is the expectation of the return that an investor expects to earn in the future. Historical returns are calculated obviously from historical data, while expected returns are determined by the risk-free real interest rate, expected inflation, and the risk premiums. Even though investors sometimes use historical returns to forecast expected returns, one must bear in mind that there is no guarantee that returns earned in the past will be earned in the future. The risk return trade off. Every investment decision involves a trade off between the risk and return. Empirical evidence has shown that over the long run, market prices rewards higher risk with higher returns. In order to evaluate investment using mean, expected return, and variance, that is risk, we need to make a couple of assumptions. Firstly, that the returns must follow a normal distributions, which is fully described by its mean and variance, and the markets must be informationally and operationally efficient in order to incorporate all new information. When these assumptions are violated, we need to consider other investment characteristics. The distributional characteristics. We have discussed the characteristics of a normal distribution in the QM section. The mean variance framework is only appropriate for evaluating investments whose returns are normally distributed. In reality, however, returns are not always normally distributed. Deviations from normality may occur either because of skewness or kurtosis. Skewness refers to the asymmetry of returns distribution, and kurtosis refers to the fat tails or higher than normal probabilities for extreme returns. This leads to an increase in an asset's risk that is not captured by the mean variance framework. The market characteristics. Markets are not always operationally efficient. One limitation in operational efficiency in markets is liquidity. Liquidity has an impact on the bid-ask spread, that is, illiquid stocks have a wider spread, and on the price impact of a trade, that is, illiquid stocks suffer a greater price impact. We now move on to understanding the concept of risk aversion. Suppose an investor has two alternatives. One, he is guaranteed $25 in 1 year. Secondly, he is guaranteed 50% chance of $50 and 50% probability that he'll be getting nothing. If you work out, okay, here also the overall probability 50% of 50 plus 50% of 0 turns out to be 25. The expected value in both these cases is 25, but there are three possibilities regarding the investor's preference. The first possibility is where the investors may play it safe and go with option 1. This behavior is typical indication of a risk aversion. Risk averse investors aim to maximize returns for a given level of risk and minimize risk for a given level of return. The investors may choose to gamble and go with option 2. Such risk-seeking investors get extra utility or satisfaction from the uncertainty associated with their investments. Even though most individuals do exhibit risk-seeking behavior in isolated situations, risk aversion is the standard assumption in the investment arena. And finally, An investor, as the third option, can be indifferent between these two options. Such risk neutral investors seek high returns irrespective of the high level of risk. Risk tolerance refers to the level of risk that an investor is willing to accept to achieve his or her investment goals. The lower the risk tolerance, the lower is the risk acceptable to the investor, and the lower the risk tolerance, the higher is the risk aversion as well. The utility theory and indifference curves. In the investment management arena, utility is a measure of the relative satisfaction that an investor derives from a particular portfolio. For example, a risk averse investor obtains a higher utility from a definite outcome relative to an uncertain outcome with the same expected value. In order to quantify the preferences for investment choices using risk and return, utility functions are used. An example of utility functions with its legends are there on your screen. A is a measure of the risk aversion. It is higher for investors who are more risk averse and as they require larger compensation for accepting more risk. The utility function listed above assumes a couple of things. Firstly, investors are generally risk averse but prefer more return to less return. Secondly, investors are able to rank different portfolios based on their preferences, and these preferences are internally consistent. This means if investment A is preferred over B and B is preferred over C, then investment A must be preferred over C. Therefore, we can draw a couple of conclusions. Utility is unbounded on both sides. Higher return results in higher utility, and higher risks results in lower utility. And the higher the value of the A, the higher the negative effect of risk on utility. Utility cannot be compared across individuals because it is a personal concept. Consequently, it cannot be summed among individuals to determine the utility from a social or societal standpoint. The risk-free asset which has a variance or a risk of zero generates the same utility for all type of investors. Do note that utility is not an absolute level of satisfaction. A portfolio with a utility of 2.5 is not necessarily 2 times as satisfying as a portfolio with a utility of 1.25. However, the former would definitely be preferred to the latter. Important points regarding A, the risk aversion coefficient. Risk aversion coefficient is positive for risk averse investors and additional risk reduces total utility. It is negative for risk seeking investors and it enhances total utility if he takes additional risk. Finally, it equals to 0 for a risk neutral investor as additional risk has no impact on total utility. The risk return trade off that an investor is willing to bear can be illustrated by an indifference curve. An investor realizes the same utility or satisfaction from every point on a given indifference curve. Since each investor can have infinite number of risk return combinations that generate the same utility, ICs are continuous at all points. 2 points relating to ICs for risk averse investors are worth noting. Firstly, ICs are upward sloping. This means that an investor will be indifferent between two investments with different expected returns only if the investments with the lower expected returns entails a lower level of risk as well. And ICs are curved and their slope becomes steeper as more and more risk is taken. The increase in return required for every additional unit of risk increases at an increasing rate because of diminishing marginal utility of wealth. The following figure illustrates two indifference curves. While an investor would be equally happy at any point on IDC 1, okay, the investor would prefer any point on the indifference curve 2 to any point on indifference curve 1. This is because indifference curve 2 offers a higher level of return for every given level of risk as compared to indifference curve 1. The utility of risk averse investor moves as we move northwest. The slope of the IC curve represents an extra return required by the investor to accept an additional unit of risk. A risk-averse investor would have a relatively steep indifference curve, that is, significant extra return required to take on more risk. A less risk-averse investor would have a flatter indifference curve. A risk-seeking investor would have an indifference curve with a negative slope. His utility would increase with higher return and higher risk. And a risk-neutral investor would have a perfectly horizontal indifference curve. That is, the utility of that investor does not vary with risk. Whatever I said is clearly exhibited by the diagram on your slide. This diagram shows the indifference curves of various types of investors, and from an exam perspective, I would want you to spend a couple of minutes on the same. The risk aversion coefficient in the utility function and the slope of the indifference curve are positively correlated. For the remainder of the section in portfolio management, we will assume that all investors are risk averse. Now let's look at an example which illustrates the computation of utility based on the equation that we had seen. So using the utility function formula that we had seen in the first slide, okay, when we were discussing the same, okay, I would want you to solve the following question based on that formula, where utility equals to expected return minus half of A into sigma square. So based on this formula, I would want you to solve the following questions. We saw that formula on the utility curve and the indifference curve slides. If you do not remember it, please go back, pause the video, write down the formula, come back here, solve the questions, and then wait for the solution. The following table shows the utility for risk-averse investors with A equal to 5 and A equal to 3. A risk-averse investor with a risk coefficient of 5 would choose investment A. On the other hand, a risk-averse investor with a risk coefficient of 3 would choose investment D. A risk-neutral investor's risk coefficient is 0, and therefore he might want the highest return possible and therefore would choose portfolio D or investment D. A risk-loving investor likes both higher risk and higher return, and therefore that investor would choose portfolio or investment D as well. Application of the utility theory to portfolio selection. The risk-free asset. The expected return on a risk-free asset is entirely certain, and therefore the standard deviation of its expected return is 0. The return on this risk-free asset is the risk-free rate. The relevant portion of the CFA program curriculum invests a weight of W1 in the risk-free asset. We assume that W1 equals to the weight of the risky asset in the portfolio, and the conclusion of the analysis would remain the same. The expected return for a portfolio containing a risky and a risk-free asset. Let's assume that we invest a proportion of our funds in a risky asset with a weight of W, and the expected return is ER with a variance of sigma square, and the remainder 1 minus W in the risk-free asset which has an expected risk-free return of RFR and a variance of 0 as already discussed. Therefore, the expected return on the entire portfolio can be calculated using the following equation. The standard deviation of a portfolio containing a risky asset and a risk-free asset can be given as follows. This formula shows the standard deviation of a portfolio that combines a risk-free asset with a risky asset in a linear proportion of the standard deviation of the risky asset. You need not know the derivation of the formula. The expression for the standard deviation of the portfolio can also be found out with the help of the following formula. This expression for the slope of the capital asset line, or the capital allocation line, is the extra return for each additional unit of risk and is also known as the market price of risk. At point RFR on the diagram, the The portfolio consists of only the risk-free asset. Therefore, its expected return equals to the risk-free rate and variance equals to 0. At point A on the diagram, you see that the portfolio consists only of the risky asset. Therefore, its expected returns equals to ER1 and the variance of sigma square. The return risk combination beyond point A can be obtained by borrowing at the risk-free asset and investing in the risky asset. The next question is which of these numerous portfolios along the capital allocation line will actually be chosen by the investor. The answer lies in combining the indifference curves with the capital allocation line. The indifference curve represents the investor's utility function, while the cal represents the risk-return combinations of the set of portfolios that the investors can invest in. Portfolios that lie below the cal may be invested in, but then the investor would not be maximizing the potential return given the level of risk he or she is willing to take. Portfolios lying above the cal are desirable but cannot be obtained with the given assets. Let's look at the following diagram. We see that the indifference curve 3, which lies above the cal, is most desirable but cannot be attained with the available assets. Indifference curve 1 intersects the cal at two different points, point B and point C, and both these points offer the same level of satisfaction to the investor as they lie on the same indifference curves as shown here, B and C. On the other hand, indifference curve 2 is tangential to cal at point M. Given a choice between investing in portfolio on indifference curve 1, that is points B or C, or in portfolio on indifference curve 2, that is point M, an investor would choose the portfolio on the indifference curve 2 as it offers higher level of satisfaction. Therefore, point M represents the optimal portfolio for this investor. However, portfolio selection for two investors with different levels of risk aversion is a bit different. The indifference curve of relatively more risk-averse investors, Harry, would lie on the left of the indifference curve of a less risk-averse investor, let's say Bob, because he has a lower tolerance for risk. Notice that Harry's optimal portfolio has a lower expected return and a lower level of risk than Bob's optimal portfolio. Further, for same level of return, Harry's indifference curve has a higher slope, which suggests that the need for a greater incremental return than Bob for taking additional risk. Portfolio risk. Earlier in this reading, we learned that addition to being a function of the individual asset variances and their weights in the portfolio, portfolio variance also depends on the covariance between the assets in the portfolio. The formula for the standard deviation of the portfolio of risky assets is on your screen. However, in fact, on the other hand, the formula for standard deviation of a portfolio which consists of two assets is on your screen as follows. Standard deviation of a portfolio consisting of three assets is this. From an exam perspective, the standard deviation of two portfolios can be calculated on your calculator, TIBA calculators, but for three assets, it cannot be calculated, and from an exam perspective, this three standard deviation for three risky assets is not at all testable. It definitely cannot come on the exam. The first part of the formula in the two asset portfolio standard deviation, the weight square into variance plus the weight square into variance, tells us that the portfolio standard deviation is a positive function of the standard deviation and the weights of the individual assets. The second part, that is twice into weight into covariance between the two assets, shows us that portfolio standard deviation is also dependent on how two assets move in relation to each other, either covariance or correlation. We've already understood that the maximum value for portfolio standard deviation will be obtained when the correlation coefficient equals to 1, and the portfolio standard deviation will be minimized when the correlation coefficient equals to -1. So therefore, if a correlation coefficient equals to 0, then the second part of the formula will vanish out and the portfolio standard deviation will lie somewhere in between, which will be nothing but the weighted average of the individual variances. Now we'll be looking at a couple of implications. When asset returns are negatively correlated, the final term in the standard deviation formula is negative and serves to reduce portfolio standard deviation. If the correlation between assets equal to 0, portfolio standard deviation is greater than when correlation is negative. And when asset returns are positively correlated, the second part of the formula for portfolio standard deviation is also positive, and portfolio standard deviation is higher than when the correlation coefficient equals to 0. Let's go through a brief example to highlight some important points. Asset A and B have the following expected returns, portfolio weights, variances, and the standard deviations. Portfolio standard deviations in various correlation scenarios are also given. First of all, remember that portfolio's expected return does not vary with the correlation coefficient of the two assets. The expected portfolio equals a return on the portfolio is 7.5%, which is nothing but the weighted average of the expected return. With perfectly negative correlation, the standard deviation of the portfolio is lowest at its 1%. The negative covariance term significantly offsets the individual variance term. With a covariance of minus 0.5, the standard deviation is not at lowest, but it's still relatively low at 4.09% due to negative covariance term. With zero correlation, we have a portfolio standard deviation of 5.7%, which is higher than the one with negative correlation, but lower than the one with a positive correlation. Similarly, with perfect positive correlation, the standard deviation of the portfolio is 8% and is at its highest possible level. There are no diversification benefits from investing in the portfolio when the correlation is +1. In this scenario, portfolio standard deviation is simply the weighted average of the standard deviation of the two assets. So weighted average of 9 and 7 with weights being 50-50% is obviously 8%. This is because we are just doing the weighted average. The conclusion is that the risk or the standard deviation of a portfolio of risky assets depends on the asset weight and standard deviation, and most importantly on the correlation of asset returns. The higher the correlation between the individual assets, the higher the portfolio standard deviation. Constant correlation with changing weights. Using the same two assets, now we'll change the weights of the individual assets in the portfolio and use a constant correlation coefficient of 0 to know the impact on the portfolio standard deviation. Go through this following table carefully. From this figure, notice that the set of risk-return combinations for the 5 portfolios traces an ellipse that starts at portfolio F, assets B risk return profile, and goes through the 50-50 point on the portfolio J, that is asset A's risk return profile. With assets that have a correlation of less than 1, it is possible to form a portfolio to have a lower risk than either of the individual assets. This holds true for portfolio G, H, and I in our example. A conservative investor can experience both a higher return and a lower risk by diversifying into a higher risk return asset if the correlation between the assets is fairly low. Suppose a conservative investor is fully invested in asset B, that is portfolio F, where he or she expects a return of 5% with a standard deviation of 7%. By shifting 25% of their assets into a higher risk asset, let's say portfolio A, and investing in portfolio G, the investor can increase the expected return to 6.25% with a lower standard deviation of the portfolio of 5.71%. This figure shows the change in the curvature of the risk-return relationship between the assets depending on their weights as a function of the correlation between the two assets. Do notice that for any mix of asset weights, the maximum value of that portfolio standard deviation can take is equal to the higher of the individual asset standard deviation. From this second figure, you can know that when correlation equals to fully positive 1, the risk-return combination that results from altering the weights lie along the straight line between the two assets' risk-return profiles. As correlation falls, the curvature of this line increases. When correlation equals to 1, the curve is represented by two straight lines that meet at the vertical axis. This point represents a zero risk portfolio where portfolio return must equal to the risk-free rate to prevent arbitrage. Portfolios of many risky assets. As more and more assets are added to a portfolio, the contribution of each individual's asset risks to portfolio risk diminishes. The covariance among the assets in the portfolio accounts for the bulk of the portfolio risk. Further, given that there is a large number of assets in the portfolio, if we assume that all assets in the portfolio have the same variance and the same correlation among assets, the portfolio can have a variance of zero, that is zero risk, if the individual assets are unrelated to each other. So that's all. Thank you.